Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2, we'll explore the advantages and risks of foreign currency bonds, plus some key strategies for investing in them. Key factors to consider before buying foreign currency bonds. Investing in foreign currency bonds can be an exciting way to diversify your portfolio, but it's not something to jump into without careful thought. These investments carry opportunities and risks that are influenced by factors like currency volatility, issuer reliability, and tax rules. Before making a decision, it's important to focus on a few critical areas that could impact your returns and risk exposure. Credit ratings of the issuer. The issuer's creditworthiness is one of the most important things to consider when buying foreign currency bonds. Essentially, you're lending money, so you need to ask yourself, how likely are they to pay it back? Credit ratings are a key tool for gauging the issuer's ability to meet its financial obligations. Agencies like Moody's, Standard & Poor's, S&P, and Fitch assign ratings to governments, corporations, and other entities based on their financial strength and repayment history. A higher credit rating typically signals lower risk, while lower ratings often indicate higher risk. Here's why credit ratings matter. Lower default risk. Higher-rated issuers are less likely to fail in paying back the principal and interest. Impact on yields. Bonds with lower ratings often offer higher yields to compensate for the added risk, but the potential for default can outweigh the extra income. Economic stability indicator. The credit rating reflects the issuer's overall economic and financial health, which can provide insight into stability. You don't have to stick only to AAA-rated bonds, but weigh the risks carefully. For example, emerging market bonds with lower ratings may offer great returns but could suffer from economic or political instability. Currency performance trends. Foreign currency bonds are, by nature, tied to the performance of the currency in which they are issued. This adds another layer of risk and opportunity that doesn't exist with domestic bonds. Understanding historical and projected currency movements is vital before buying. Currencies can fluctuate significantly due to factors like central bank policies. Interest rate changes and monetary policy decisions can strengthen or weaken a currency. Economic growth. A growing economy often supports stronger currency performance, while stagnation or recession can lead to depreciation. Global events. Political shifts, trade agreements, or natural disasters can cause sudden changes in currency value. For example, imagine you've invested in a bond denominated in Brazilian reais, and the currency weakens against your home currency, the US dollar. Even if the bond pays a good yield, currency depreciation could offset your returns. Conversely, if the reais strengthens, you could benefit from improved conversions. Tools like forward exchange rates, historical performance charts, and economic forecasts can help you analyze potential currency risks and rewards. A strong currency doesn't just protect your returns, it could amplify them if the exchange rate moves in your favor. Tax implications. Taxes on foreign currency bonds can vary widely depending on your home country's tax laws and the tax treaties it has with the issuing country. Failing to account for tax implications could result in unexpected liabilities, shrinking your profits. Here are a few tax-related factors to consider. Income taxes. Interest income from foreign bonds is often taxable in your home country. In some cases, you might also owe taxes in the issuing country unless a tax treaty provides relief. Capital gains taxes. If the bond's value increases due to changes in currency exchange rates or market conditions, and you sell before maturity, capital gains taxes may apply. Withholding taxes. Some countries charge withholding taxes on bond interest payments to foreign investors. For example, A country might withhold a percentage of your interest payments at the source. It's a good idea to consult a tax professional to understand how foreign currency bonds fit into your overall tax strategy. Some bonds may qualify for exemptions or lower tax rates if there's a treaty between your country and the one issuing the bond. Proper planning can help you keep more of your investment returns. By focusing on these factors, credit ratings, currency performance, and taxes, you can make a more informed decision when investing in foreign currency bonds. It's about balancing risks and rewards while keeping an eye on the details that could impact your bottom line. How to invest in foreign currency bonds. Investing in foreign currency bonds opens doors to global markets and diversification, but understanding how to acquire them is essential. There are several methods to consider, ranging from direct purchases through brokers to more accessible options like funds or ETFs. Each approach has its own benefits and risks, making it important to choose the one that aligns with your investment goals and comfort level. Through financial institutions or brokers, banks and brokers play a key role in helping investors access foreign currency bonds. These institutions act as middlemen, facilitating transactions on your behalf while ensuring you have access to the bonds available in international markets. Here's how they can help. Banks. Large multinational banks often have dedicated teams or platforms that allow customers to purchase foreign bonds. They may also provide research on global markets, helping you make informed decisions. However, banks might charge higher fees and require certain account minimums to begin investing. Brokerage firms. Many online brokers offer access to international debt markets. They allow you to directly purchase specific foreign currency bonds from issuers or through secondary markets. You can typically see real-time prices and execute trades easily, all from their platform. Some brokers even specialize in international investments, offering tools specifically for foreign bond trading. Keep in mind that fees can vary depending on the platform or institution you use. Both banks and brokers may charge commission fees, account maintenance fees, or transaction fees that could eat into your overall returns. Using bond funds or ETFs. If buying individual foreign currency bonds feels overwhelming, bond funds and exchange-traded funds might be a better alternative. With these options, you can pool your money with other investors and let a fund manager handle the details. Advantages of bond funds and ETFs. Diversification. These funds usually hold a broad portfolio of foreign bonds spanning multiple issuers, currencies, and regions. This reduces the risk of relying on a single country or company for returns. Liquidity. ETFs, in particular, are traded on stock exchanges, making it easier to buy and sell shares as needed. Lower entry costs. Investing in a fund or ETF doesn't require the large capital outlay that buying individual foreign bonds might. Even small investors can gain exposure to foreign markets. However, it's not risk-free. Managed funds charge expense ratios, which are annual fees that slightly lower your returns. Furthermore, while diversification can balance risks, it doesn't eliminate them. Any currency or economic instability in the regions covered by the fund can still affect its performance. Risks of direct investment versus pooled investment. Whether you choose to buy foreign bonds directly or invest in pooled options like ETFs, each method comes with its own set of trade-offs. Direct bond investments. Pros. Full control over your portfolio. Select specific bonds based on issuer, currency, and maturity. Flexibility to adjust your investments according to personal strategies and market conditions. Cons. Requires extensive research and understanding of foreign markets, currencies, and individual issuers. Higher risk exposure. Your returns depend entirely on your chosen bonds and their performance. Larger initial investment required, especially in markets where retail-friendly options are limited. Pooled investments. Pros. Professional management reduces the need for hands-on research. Access to a diverse range of bonds, spreading risk across different issuers and currencies. Lower initial cost and hassle-free transactions. Consi. Expense ratios reduce overall returns. Less control. You can't influence which bonds the fund includes or excludes. Fund performance might not align perfectly with your personal investment goals if it's driven by broader market trends. In short, direct investment is like driving your own car. You have full control, but that comes with responsibility. Pooled investments, on the other hand, are like taking a bus. You sacrifice control, but someone else handles the navigation. Choosing between these two ultimately depends on your investment knowledge, risk tolerance, and the time you're willing to dedicate to managing your portfolio. Foreign currency bonds offer a unique path to diversify investments and explore global financial opportunities. They combine the potential for attractive returns with inherent risks tied to exchange rates, issuer stability, and economic conditions. By understanding their features, types, and risks, investors can make more informed decisions and balance their portfolios effectively. Diligence is key. Analyzing credit ratings, currency trends, and tax implications before investing can help you steer clear of pitfalls. Whether you're looking to hedge against currency shifts or tap into higher yields abroad, these bonds provide valuable options for those with a clear strategy. Take the time to weigh the rewards and challenges, stay informed, and explore how foreign currency bonds can fit into your long-term financial goals. Ready to dive in? Start by researching opportunities with your broker or explore bond-focused ETFs for diversified exposure to global markets. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.